Hello, everyone, and welcome. Thank you for signing up to learn about our year-end tax strategies and ways to minimize your taxes. That's for today and the long term. We're really excited about today's presentation, and we believe everyone will come away with some new ideas. What you're about to hear, it represents the best and brightest thinking from our team, and it's the collective wisdom of over 100 years experience. I'm Kurt LaLomia from Turning Point Financial. A little housekeeping before we get into it. I like to be upfront in my presentations, tell you exactly what's going to happen here today, so there are no surprises. We have three basic parts to this presentation. First, we'll take you through various tax strategies and potential ways to lower your taxes. Second, we'll show how this might personally affect you. There's many factors that must be considered. Lastly, we're going to have Q&A. Please use the chat box at any time with your questions. We'll answer those at the end. We want to help you understand that there are actions you can take today that can have an impact on your life and lifestyle in the future. Everyone should be muted, and while my video's on, yours doesn't need to be. Two things that will not happen today. One, we're not here to sell you anything. This is an educational format. And two, we can't provide personal financial advice. We just can't do it in a group setting like this one. Because of that, your participation today, it entitles you to a free consult with me. All you have to do to set that up is send me an email. We'll talk more about that later on. My email address is on this slide, and I'll have it on a later slide as well. Turning Point Financial, we are what's known as an RIA. That stands for Registered Investment Advisor. The SEC is our supervisor. Our home office is in Frederick, Maryland, and we work with federal employees and clients from most agencies across the entire country. Here you have a picture of the team. Slightly outdated. We've hired 4 new people this year. I'm in the back behind Kathy. That's our owner holding the sign there in the center. One last thing, we're fiduciaries. That means we put your best interests first. And we get asked that a lot because it's important. If you're looking for an advisor, this is a good question to ask because not every advisor out there is a fiduciary and held to the fiduciary standard. Our website, tpfinancial.com. I should have that on this slide. I don't. I'll have it on a later slide. You can learn more about the team and about me there. Here's what we'll be covering today. Taxes are obviously not a fun-filled topic, and we'll do our best to keep you engaged with some real-life stories of families that we've worked with. This is a side benefit to today's presentation. While our focus is on things to handle before the end of the year to lower your tax bill, these are some things that will come across loud and clear in the presentation. Lowering our taxes this year, it's important, but you'll also learn some ways to lower that long-term tax bill. And by that, we mean the taxes you have to pay, we all have to pay over our entire lifetime. The obvious answer is you'll pay more taxes without a long-term tax strategy. Perhaps not this year or next, but it's likely it will cost you a lot more over the long term. There are little things you can do today, this year, and beyond to lower that long-term tax bill. Participating in the Roth is just one example, and I'll show you some ways and share some stories. Think outside the box for a sec. Not just what your family earns in a year and the taxes owed in a year. Think about the total of all those taxes paid during your entire working career. It's scary because it's hundreds of thousands of dollars and maybe more. What if you could chip away at it, put some dents in it, Lower that big tax bill by $50, $100, $200,000 and have that for your fun retirement money. Getting an advice from a financial planner or tax advisor, it can and does save the kind of money I referred to. I see it all the time. But for it to work and to maximize the impact, it needs to be done well ahead of retirement. You simply can't start on this sort of thing too early. For most people, if you do nothing and simply keep doing what you're likely doing today, you'll end up with what we call the government plan, which is paying taxes for the rest of your life at whatever rates they tell you. You have a choice. You can make your own plan by acting today and actually creating tax-free sources of income. The Roth is one of the ways to do this. That can be Roth TSP, Roth 401k, or Roth IRA, just to name a few. The choice is yours. You can take their plan and adapt as tax laws change, or you can make your own plan. If you're making your own plan, I suggest working with someone who knows what they're doing. Long-term tax planning, that involves understanding all your sources of income during retirement. That would be your pension, Social Security, RMDs, which means required minimum distributions, and we'll talk about those later on. Other sources of income during retirement, that would be the Roth. It could be part-time income, rental income, if you have a spouse or partner, whatever they have going on. A portion of each of these, it's taxable, and the impact it has is something you need to know. It can be complicated. We all agree it's okay to pay our fair share, but no one wants to leave the IRS a tip. Creating a financial plan early on and getting in front of the tax obligation, it's one way to make your own plan. Roths, they remove the uncertainty of future tax rates because Roths are funded with after-tax dollars. Put things on autopilot. Have money come out of your paycheck each pay period automatically. That's likely what most of you are doing today with your TSP. Or if you have a spouse or partner in the private sector, that would be their 401k, 403b, or even something else. But we want to automate everything. Just like the TSP is today, you also want to automate the FSA, the HSA, and 529s if you're doing college planning. FSA stands for Flexible Spending Plan. That's an account for medical expenses and dependent care. HSA stands for Health Savings Account. You use that for medical expenses, and you have to have a high deductible medical plan in order to be able to contribute to that. Contributions to all of these types of accounts that can lower your taxable income. A little more on the HSA, if you have one of those. Build that up. Think of that as a savings and investment account. And you can use that in retirement to pay for a variety of medical expenses. Think of it as a Roth IRA for medical expenses, only it's triple tax-free. It's a no-brainer. Money goes in pre-tax, grows tax-free, comes out tax-free, so long as you're using it for medical expenses. And it gets even better. You can invest the money. So if you're young, an HSA is probably the absolute best thing you could be doing. Different types of accounts offer different strategies. If you have options to take money from accounts that offer different tax rates, you're truly in your own plan and not the government plan. And that is where we should all strive to be. Again, the types of accounts I'm referring to are Roth and traditional IRAs, investment accounts, 529s, HSAs, FSAs, and bank accounts. I've been a do-it-yourselfer off and on over the years, so I get it. Since we created our tax department nearly 2 years ago, I'm constantly amazed at how our CPA finds mistakes in tax returns. And it's not just from the do-it-yourselfers, but professional tax preparers are making mistakes. TurboTax, in my opinion, or any other software, that can be manipulated. It works with what you tell it, and it's not proactive. It cannot do the type of tax planning we're talking about. I'm not trying to sell you on our tax services, but just open your eyes to the things we encounter all the time. Working with someone you can trust and someone who proactively gives you advice, that's where we all should be. When we do financial planning for our clients, I'm constantly pushing for ideas and recommendations from the tax department to improve a family's financial situation and address that massive long-term tax bill. Hang with me on this a sec. If an individual makes $100,000 and pays $25,000 a year in taxes over a 30-year career, that's $750,000 in taxes. What if we could reduce that to $650,000 or $600,000? That's serious money saved that could be invested along the way to provide for an early retirement, or certainly a more comfortable retirement. Audits and red flags, everyone should know that the IRS never calls. It notifies by mail. And I'd say get help if you don't understand your audit. Red flags, those are going to be unique to each family. One of our clients was making major mistakes in their tax life, despite having their taxes done by someone else. As I said before, mistakes are common, and unsolicited advice from CPAs or tax preparers, that's uncommon. Always ask your tax preparer for ideas and suggestions. Many are simply not forthcoming. Some examples of what we uncovered with this client: they weren't taking advantage of deductions for medical expenses, including mileage. This client has 3 kids and they're doing well, saving for college, but they were missing out on their state's generous deduction. Happened to be New York State, which provides a $10,000 tax benefit with its college savings programs. The client, they had a Roth, but they weren't utilizing it fully. We suggested setting up another for their spouse and making annual contributions. Family also had someone considered special needs, didn't have an ABLE account, thereby missing out on its tax benefits. Lastly, the long-term tax strategy that we recommended, which includes Roth Conversions, that will save our clients several $100,000 in our estimation over their lifetime taxes. I point all this out because I believe each of us needs to take a close look at our personal circumstances. The question to ask is, am I overpaying the IRS? Hang with me, folks. I know this is a lot. It's worthwhile. We're going to get into the Roth a little more on these next 2 slides. The Roth is one way to incorporate a strategy to manage the uncertainty of what future taxes might look like. Everyone on the call today should have some of their retirement plan invested in its Roth portion, if you have that option. I know most of you on the call today have the TSP. The TSP has a Roth option. If you're in the private sector and you have a 401k or 403b, I suggest you find out if you have the Roth option and utilize it. If you don't have it, you might consider a Roth IRA. And by the way, everyone can participate regardless of your income. If you believe or you've been told you make too much to have a Roth IRA, you're misinformed. A little used strategy called the Backdoor Roth that allows high wage earners to have Roth IRAs. Let me know if you'd like to know more about that. I just want to pause for a second and make sure everyone is understanding this. What we're suggesting is a Roth IRA, which you would do on your own or with someone like me, or Roth participation in the TSP or 401k, 403b. You can do both. Some people do both. The Roth, it's funded with money that's already taxed, and it grows completely tax-free. It then comes out tax-free. When you need money in the future, you can use the Roth without having to pay extra taxes. Think about it. If the tax rate's higher in the future, you'll be in a great position if you have access to tax-free money. That's the Roth. Anyone with a 401k, 403b, TSP, you need a tax solution. And taking advantage of today's tax rates on sale is the way to be thinking about the Roth. Roth conversions, that's something I do every year as part of my long-term tax strategy because it allows me to lock in today's low tax rates. You're paying taxes once and never again. Having a Roth, it removes the uncertainty of future taxes. Best of all, they're invisible on your tax return in retirement. The Roth conversion, it's simply converting or moving money from a traditional IRA to a Roth IRA and paying taxes on the amount you convert. Those taxes you pay when you file. If you or your spouse have old 401ks, 403bs, or IRAs, you can use them to jumpstart the Roth. Just to repeat, it involves paying taxes now in exchange for not having to pay tax on distributions later, like during retirement. What do you estimate the future of your RMDs if you do not convert? I convert a small amount each year because the tax bill on converting the entire thing, it would be too much. That's my plan. And I want my plan, not the government plan, which is RMDs. RMDs are required minimum distributions. Those start at age 72 for any traditional plan. That's going to be IRAs, TSP, 401k, 403b. We call this the government plan because it forces you to take a certain amount out each year, whether you need it or not. This is how taxes are collected. Those RMDs are taxed. Roths, they never have RMDs because you paid the tax up front. This slide here shows the value of the Roth, the blue line here, versus not having a Roth. And you can see it's about 20% greater or $100,000. I work for a financial planning firm, Turning Point Financial. That's our bread and butter. That's how most people come to know us and work for us. So I'm admittedly biased. Here are some of the things that come up in the plans that we do for families. If you don't have a plan, you only have a wish and no roadmap to achieving that wish, that goal, that dream, whatever. You may still get there, but it'll likely take a lot longer and be a lot more frustrating. A recent planning client, they had a dream of retiring early, and they had been a good saver and investor their entire career. But he had too many accounts. He didn't know how his money was allocated. He wasn't taking advantage of college savings plans that offered tax benefits. There was too much money in savings accounts that wasn't earning him anything. There was no Roth participation, and there was no long-term tax strategy. With our advice, solid direction, and accountability, this client will get to do everything he wants for his family and will realize close to $1 million in savings with the strategies we recommended. Had the client waited until he was on the cusp of retirement to have a financial plan done, the cost of waiting for him, well over $1 million. Obviously, not everyone can reap savings this large because each of our circumstances are unique, but savings of some sort is possible for everyone. You won't know if you're ready to retire without knowing what you'll need. in this new phase of your life. It's never too early to start planning, and to do it right, you have to dig into the details. The process, it gives you clarity, and you'll really know what to expect. You get to see how everything works together, what you make, what you spend, what you have, and what you need. Taxes are often ignored, but can make a huge difference to your bottom line, as we've shown. Here are your action items. By the way, these slides are available upon request, and we've also recorded the presentation. Let me know if you'd like copies. We covered what happens when you don't have a long-term tax plan. Automation. Just get started at any amount. Getting started is more important than how much. That's because you're going to bump it up every year by a certain dollar amount or a percentage. When my two girls were born, we started a college savings plan at the minimum, 15, 20 bucks a month, just got it going. And then each year when the opportunity presented itself, we bumped it up a little bit. And it worked out for us. That's the way to think about this. Just get started, just automate it. Bump it up when you can. Third, talk to someone about making sure you have the right accounts set up to manage taxes in a way that's most efficient for your circumstances. Does your financial plan and tax plan, do those complement each other? What does that mean? Well, are your CPA and your CFP, that certified financial planner or advisor, are they talking to one another about strategy, about taxes, about your goals, and trying to be efficient? One of the things I love about where I work is we've got all that under one roof. It's completely integrated. Make Roth contributions in any and every way you can now. It's on President Biden's chopping block. The Roth advantages and benefits, they may not be available to us in the near future. That sort of goes to the last one, which speaks for itself. Ignore the noise. Don't get too caught up in tax proposals right now. They have a long way to go. There's a lot of good ideas out there. Something's going to happen, but try not to get too caught up in that. We're going to get to some questions here in just a minute. My contact information is here on the screen. If you prefer, you can email me with your question and we can take it offline. The biggest mistake we see people make, it's not asking for help when they need it. Fortunately, you have resources. Several federal agencies, they've asked me to be a resource to you. Please contact me if you need help or have questions about anything we discussed today. I mentioned the free consult early on. Your participation today entitles you to that 15, 20-minute call to talk about things you may not have completely understood today or some other aspect of your financial life that's troubling you. Be happy to help you out with that. That's a free call, no obligation. Shoot me an email and we'll get that scheduled. If you have a question, please pop that in the Q&A and we'll take those. We've scheduled an hour and we're almost to the halfway point, so we've got plenty of time for any questions. Again, we recorded this and the slides are available upon request. Please send me an email if that's something you'd be interested in. I'll give it a few minutes for questions to be compiled. Our first question, I've been seeing Congress is discussing canceling the backdoor Roth plans. Is this true? Yes, they're discussing it, but until it's final or until we know it's coming, until they're further down the road, I wouldn't get too worked up about it. If you're not participating in the Roth at all, I would jump on that. I would get started with that right away in your TSP or with an IRA. We have to wait and see. What's the difference between a CPA and a financial advisor? Well, CPA stands for Certified Public Accountant. So they're well-versed in accounting and taxes. Many CPAs do tax work, file tax returns. Their taxes are their expertise. Financial advisor, that's what I am. I'm also a certified financial planner, which is the CFP designation. That means I've taken a lot of classes and exams around all the different aspects of financial planning, estate work, budgeting, investments, retirement planning, taxes. I'm not a CPA, but I have an interest in taxes, and that's why I've been a do-it-yourselfer off and on over the years, looking for ways to reduce taxes for my family. Oftentimes, your investments have tax consequences. That's why it's important to have the right accounts, the right types of accounts set up, traditional and Roth IRAs, taxable brokerage accounts, and work with a CPA, the tax preparer, to make sure you have the right accounts set up and you're doing things in the most tax efficient manner. I may come back to that some more. So one focuses on taxes, the other focuses on financial planning, investments, that sort of thing. Another question, is it too late to obtain the services of a CPA for the 2021 tax year? No, it's not. If you have an interest in that and learning more about that, send me an email, and we're signing up people for 2021 taxes right now and through the end of the year. Obviously, taxes don't have to be filed for nearly 6 months. So, but we're gearing up with our existing clients and preparing for them and doing projections and tax preparation right now in preparation for 2021. Someone's asking, what dangers of joint accounts did you refer to? You may have misunderstood. I don't think, if it came across that way, I apologize. I don't know that there are any dangers in joint accounts. What I was referring to is having different types of accounts. There are certainly benefits to having joint accounts and different designations that go along with different types of joint accounts. There's tenants in common, there's joint tenants with rights of survivorship, there's transfer on death that go along with various types of accounts. So having different types of accounts that offer you different options as life goes on, that can help minimize taxes. That's what I was referring to. Someone's asking if federal employees can have health savings accounts in addition to the ones provided by the government. The answer there is really no. You have to have what's known as a high deductible plan, and that's one of the plans in your offering. And we're coming up on open enrollment very soon. really, so choosing a health plan to have an HSA should not be your primary focus. You got to choose the health plan that works best for your family and offers the benefits and features that fit your family. But it's the high deductible plan. You have to be in a high deductible plan, which means you have a lot of out-of-pocket expenses in order to qualify for having an HSA. The other way you might get it is if your spouse or partner has a different employer that offers that as part of their benefits. And just like contributing to a Roth, there are limits as to how much you can put in there. One of the benefits of the HSA over the FSA is the HSA funds roll over each year. You can accumulate vast sums in there for your medical expenses and pay all of your medical expenses on a tax-free basis. The FSA, still a great option, but not all of that is rolled over. So you got to be smart with your budget and figuring out how much you want to contribute to that each year. Somebody was late to the meeting and they want copies of the slides and the recording. Happy to send that. Just bear with me, folks. Taking some notes here. Really appreciate the questions. Okay, our next question is really, it's a pretty common one. And the question is, are Roth conversions possible with the TSP? The answer is no. So Roth conversions are done outside of the TSP as well as any other type of employer plan, 401k, 403b. You have to roll the TSP over to an IRA, and then the traditional IRA can be converted into the Roth IRA. So it's done outside. You can certainly do that at retirement or above a certain age, but unfortunately that it's not available in the TSP. Another option for you is simply begin contributing to the Roth portion of your TSP to build up that balance. So conversions are done only with IRAs, not with TSP or 401k. If a tax client gets audited by the IRS, how does your company handle this? Well, we work with them. We coordinate it. We handle it. We communicate with the IRS. That's one of the benefits of having a tax and accounting professional do your taxes. Good questions, folks. Really appreciate it. Going to read some more off here. In regards to health exchanges, are there financial advisors who are knowledgeable that can incorporate considerations for those who perform dependent care and are looking at their whole financial portfolio? I think I'm going to have you send me an email. If you can email that question to me. I'm not quite understanding it, so I don't really want to get into it. I mean, we have some familiarity and experience with that sort of thing, but the answer to your question is yes. Next question, the majority of my TSP is in traditional. Can I move it over to a Roth now, or I have to wait until I retire to move it to a Roth? You have to wait. It can't be done in the TSP. Start contributing to the Roth portion of the TSP. Stop contributing to the traditional. If you have a sizable balance in traditional, you need Roth. So I might suggest 100% of your current contributions start going to the Roth to build that up. What is the status of being able to take cash out of investment accounts and avoiding penalties due to the pandemic? There was some rules that were relaxed last year that allowed people to take money out. That was last year, and that stopped at the beginning of this year. I'm not aware of anything that currently exists that allow you to do that without avoiding the taxes and the penalties. It's typically a 10% penalty if you're below the age of 59 and a half, and the taxes owed. The taxes are at your current income tax rate. Another question on the audit. Somebody says they were audited and their tax accountant said they'd have to pay a large sum per hour for her assistance. She would not take his calls at all. Well, let's just pause for a second here. If a lot of work is going to be required to help someone get through the audit, I mean, wouldn't you expect to pay for that? You know, paying for the tax return and the time involved in that is one thing. Perhaps there's some firms out there that charge a larger fee for the tax return being done, and if there's an audit, that's bundled into helping you work through that. But if the CPA is going to have to do hours and hours and hours of work related to somebody's audit, I think you would expect to have to pay for that. And it's probably worth it because they know what they're doing. They know how to speak to the IRS. They know how to present the material. I've been audited before and I handled it on my own. It's nerve-wracking. It's nerve-wracking because you never know. You never hear anything back. You send this stuff in and 3 or 4 months later, they come back to you and they ask for more. I thought I was done. I thought it was complete. Stuff seems to go into a black hole, and sometimes they come back to you for more and sometimes they're satisfied. So that's another reason to do it. Every accounting firm is going to work a little bit differently. I would say we would charge for it, but I mean, we're very good about offering up estimates and disclosing what an hourly rate would be if it's going to be, you know, long and involved. Hope that helps. If you have a question, folks, let's put that in the chat or the Q&A field. A couple of people asked for a copy of the presentation and recording. I'll get that out to you. By the way, November, we've got an exciting presentation planned for November. around special needs planning. If you have a family member who's special needs or know someone that's special needs, please share the invitation with them. Teresa will be sending that around again on Monday. She sent one yesterday, but those will be going around to you in the blast email format from Ezra. And I believe you get those Monday and Tuesday next week. We have an expert in the area of special needs planning who will be talking about benefits available from the federal government, from state governments, local governments, and resources that you may not be familiar with. What else can I help you out with? If you got a question, pop it in the chat here or shoot me an email. Really appreciate your participation today. Early December, we'll be doing another presentation on something called morally responsible investing. Some of you may be familiar with ESG movement. That's called environmental, social, and governance. That has to do with investing in a cause, investing with your heart, aligning your values with how your money's invested. That's becoming quite a big thing, and more investment firms are talking about that and offering different types of solutions around that. So we'll be doing a presentation on that in December. Currently, the TSP doesn't offer that, but if that's important to you, that might be something to tune into. Any more questions? I think that's it, folks. I really appreciate you being here today. It doesn't look like we have any more questions. I hope you found some value in this. If you want to reach out and schedule a one-on-one meeting, again, that's complimentary. That's 15, 20 minutes to get to understand your situation and circumstances better. No cost, no obligation. Let me know. The website, tpfinancial.com. I encourage you to check that out. You can learn more about the team, our services. My bio's on there as well. And we'll be doing more presentations over the next couple of months through the end of the year is right now what we're doing. Hope to get back in person at the USDA someday. I'm told January is a new tentative date, but we'll see. So thank you all very much. Be safe, stay healthy. Have a great afternoon.